Good evening, ladies and gentlemen. A very warm welcome to all our participants, dignitaries, our esteemed speakers, industry representatives to the first online startup series of the year, Indian Startup Ecosystem, organized by the IMC Chamber of Commerce and Industry. All participants will be muted to avoid any disturbances during the course of this session. To consume less bandwidth and clarity, you are requested to stop video streaming at your end. Kindly post all your relevant queries in the chat section so that the same can be addressed as time permits. And most important, do send us your feedback on the link provided in the chat section so that we can keep improving our services based on your valuable suggestions. Now, as session, may I request Mr. Anand Singhania, Vice President, IMC Chamber of Commerce and Industry, to present the welcome address. Over to you, Mr. Singhania.
Thank you, Selby. A very warm welcome to each one of you for this first online startup series, the Indian Startup Ecosystem. On behalf of the IMC Chamber of Commerce and Industry, I'd like to extend a warm welcome to all the esteemed guests, distinguished speakers, and delegates to this very timely session. A lot of us who are attending this think that we've missed investing in so many unicorns which have really done India proud. As you know, India has become the third largest ecosystem in the world for startups after the US and China. It's added almost 3 unicorns per month in 2021, as per the recent economic survey 21-22, and the pace of growth is not showing any signs of slowing down. As of a month ago, India had over 83 unicorns with a total valuation of almost $275 billion. Most of these unicorns are in the services sector, which contributes over 50% to India's GDP. We all use them, be it whatever. The survey also noted that the government recognized over 14,000 new startups in 21-22 alone, against only about 730 in 2016, which, if you see, is a huge leap over a few years. The Indian startup ecosystem has been evolving continuously. It originated with software services, which served Indian software needs and later expanded to exporting software services. The next generation of Indian product startups had founders who had worked in these services startups or who were moving back from Silicon Valley or leaving the high echelons of the IITs and the IIMs who started this. These people had experience in the best technologies, had the risk and appetite, and more importantly, had a direct exposure to the entrepreneurial environment in USA and other major markets. During this period is when companies like Flipkart, InMobi, Zomato, etc. came into being. Venture capital investments were kicked off by the Technology Development and Information Company of India, a Government of India entity, followed by other investors from Silicon Valley. And in the past decade, with the combination of greater mobile penetration, easy internet availability, and rising aspirational lifestyle of urban Indians, India has become a hub of billion-dollar firms like Byju's, Paytm, Nykaa, Ola, Oyo, several others. And each one of us are aspiring to have been in the value creation of these startups. To discuss and understand this highly volatile and much talked about ecosystem, as a chamber, IMC felt the need to understand and interact on how a favorable environment can be created to motivate and encourage the entire startup ecosystem. To comprehend the complexities, the obscurities, and complications faced by the startups, we have initiated this online series on topics concerning the startup ecosystem. Today, we have an array of speakers. We have the founding chairperson of the IMC Startups and Innovations Committee, Ms. Paula Mariwala, who's also the founder of Aurolis Ventures. She's also founder of co-president of Stanford Angels and Entrepreneurship India. And she's joined by Sanjay Mehta, who's the founder and partner of 100x.vc, who's also the co-chairman of the IMC Startups and Innovations Committee as our speakers. I've had the pleasure to interact with both these speakers, and I'm certain this session will be both informative, educational, and useful to each one of you. Today's discussion will focus on the current landscape of the Indian startup industry, startup ecosystem, and some of the key criteria investors should consider while evaluating startups. This session is being moderated by Mr. Siddharth Lulla, who's the Director, NSL Fashion Private Limited, and a member of the IMC Startups and Innovations Committee. Before I hand over to our moderator, I'd like to brief you that the IMC Chamber of Commerce and Industry has a rich legacy of over 114 years. It was founded way back in 1907 by a few merchants who came together to establish a Swadeshi institution to fight for the rights of the Swadeshi business in the pre-independence era. The Chamber exclusively serves the interests of Indian business community and also took part in several key political movements. In recognition of the Chamber's contribution to nation building, Mahatma Gandhi accepted the honorary membership in 1931. I must say, IMC is the only chamber where Mahatma Gandhi was a member, which is truly an honor for the Chamber and an immensely proud legacy. Even at the release of the centenary year, in the IMC's postal stamp was issued by the Government of India, recognizing the work done by the Chamber. Over the years, a galaxy of speakers, both Indian and international, including presidents and prime ministers, have adorned the Chamber by their visits. The theme of the Chamber this year has been Engaging Maharashtra, Building India. The Chamber's activities revolve around this theme. In this time of economic crisis, we believe that the private sector should increasingly engage with the government in the center and states to build capacities and systems which are resilient to future shocks. Towards this, IMC is continuing to focus on engaging with both Government of India and Government of Maharashtra in its endeavor to contribute and complement their efforts to create a sustainable growth environment. Thank you, and I welcome you all for this wonderful session. Over to you, Selvi.
Thank you. So as we start the session, may I request our moderator for the session, Mr. Siddharth Lulla, Director, NSL Fashion Private Limited, and a member of the IMC Startups and Innovations Committee, to initiate the discussion. Over to you, Mr. Lulla.
Thank you so much, Selvi, and thank you so much, Paula. Thank you so much, Sanjay, for participating in this. We're really excited to have this discussion, and I hope it's insightful for the audiences with us. Really looking forward to this one. And just to start, we'd love to get a perspective from you, Paula and Sanjay, that given the amount of investments that you have done over the last decade, and also more interestingly over the last few years, how you've seen the entire Indian startup ecosystem evolve.
Sure, Sid. Thank you, and thanks to IMC. Always a pleasure to talk to this community. Sid, over the last few years, if you just look at how the ecosystem has evolved, I think you will equate it to a unicorn itself, because we have grown non-linearly. We've taken our time, but now the growth has been stupendous in various ways. It's not just the number of unicorns, which, as is being written about all the time. We started with our first unicorn, Sanjay, I think it was InMobi in 2011 probably, and followed by Flipkart, and then followed by maybe Paytm, Ola, one of the, but it was like 1 or 2 maximum a year. I think in the last 3 or 4 years, I think since 2018, this has completely gone non-linear. So valuations have increased, which makes the unicorn, but also value creation has increased. this has led to a birth of a lot of new ideas, which have been not only supported by angels like Sanjay and myself, whole bunch of VCs who've come from all over the world. Some part government, some part corporate as well, but that's been a little slower. But if I just compare over the last 15 years since I've been involved, I think what has really changed is the whole core, the whole DNA. I think when I started in this ecosystem in about 2005, 2006, we were recovering from the hangover of the dot-com bust. We really didn't have faith in some of these non-linear models or disruptive technologies. We were really hanging on to this linear services model, which had done very well for India, the IT services. So I think innovation was very slow. We would see a handful of companies come to pitch to us. Over the last 5 years, this has changed drastically. I think what has really changed is the confidence of founders, and because they have role models, they have seen this ecosystem actually succeed. They have so many companies that they can look up to. There is also availability of people who are willing to join this very risky businesses, right? Because these are by nature definitely more likely to fail. And it was extremely difficult. Not that it's not difficult now, but earlier it was, when we, about 10 years ago, it was very difficult to get good talent. Now, young people out of colleges, engineering colleges or regular colleges want to join startups. So I think on all fronts, things have changed in terms of just the opportunities for businesses to create disruption or to ride along on certain waves. The confidence of entrepreneurs and the kind of support they are getting from the risk capital that is available, the opportunities for VCs and angels like ourselves, and most importantly, there is a real opportunity for young people to join these founders and contribute to ecosystem building. And underlying technologies have really enabled this, right? The whole shift from mobile data being so expensive to mobile data being ubiquitous today, that has given access, and that's opened up, the whole Bharat market. It's given data and technology in the hands of common people, and that has really, really quadrupled, I think, the kind of opportunities that innovative founders can take.
Got it. And Sanjay, your thoughts, please, on the same?
Yeah, I think I echo what Paula is telling. But if I have to make a different statement, I think it's the underlying technology which is playing a big role in terms of creating fundamental changes in the disruption of various existing industries. Let's take, technology like GPS. If it wouldn't have been there, we wouldn't have seen Ola getting built across or Swiggy getting built across. So technology disruption, which is happening across, and the business models which are getting created around those technology disruptions are enabling, a lot of startups to scale and disrupt the existing industries. And in last whatever decade we have seen across, immense number of opportunities have been created. Let's take a great infrastructure change which happened across due to UPI, I mean the Unified Payment Interface, which came across. A lot of payment startups are, BharatPe would not have been there if UPI would not have been created, right? I mean, tremendous infrastructure changes are being done across within India and due to technology. So I think we are at a cusp where new industries are emerging across. I think venture capital as an industry, it's bringing in a lot of changes in the existing markets, creating new markets, new industries. And I think it's a great time for investors like us who write the first check, who discover those, the future unicorns or icons of tomorrow and invest today. So I think it's a great time to take and punt and invest into various tech or tech-enabled startups. Uh, I think India is now a unicorn nation. If Israel was a startup nation, I would say India is a unicorn nation. That's I think how I would put up India today.
Got it. No, that sounds really interesting, and thank you so much for this perspective, which gets me to this other question, wherein given that the last decade we've seen a lot of investments in, let's say, digital infrastructure, it would be great, if you could, from your perspective, share, to the audiences the kind of, investments that you have done the last, 3 to 4 years, and what are the kind of sectors or the kind of investments that you think are going to happen over the next, 4 or 5 years, over the next decade, to, better, give a judgment in terms of, how do we see this entire market evolve, or what are the kind of technologies that we will play a big role in shaping our future?
I think we have the grounds laid out, and COVID has just accelerated everything. We never had an home economy. Today we have an economy which is at home, right? Everything which is serviced at home, kind of stuff. New sectors like future of work is emerging across. We never, I mean, we either had a consumer, which was B2C or a B2B. Now we are having enterprise kind of future of work setup, which is being greatly, kind of disrupted in terms of how the future of work is getting evolved across. So I think opportunities are immense. We are seeing across fintech. I think fintech, India itself will see across another 100 unicorns in fintech by 2025, or maybe 2 years more. But fintech, one sector itself, we will see across 100 unicorns. Today, world's biggest edtech startup is in India, right? So highest value. So I think we are leading in every front, and more capital is going to flow in India. Especially the way I see across is new capital, which will emerge from domestic players. So, for example, today, corporate venture capital in India is emerging thick and fast. We saw last year, Tata, Reliance, both of them very active in terms of saying that let's acquire startups. We never had seen across Indian corporates buying startups, right? They were always saying that, oh, we can invest this and build ourselves. Today, they have understood build versus buy. So Indian corporates are investing in buying startups, investing in startups. So a lot of capital is coming from there. Indian family offices, I mean, I work with so many of them. It is just amazing the way Indian family offices have opened up the purse to this asset class, right? And they are doing both via fund and direct investing. So I think it's an amazing story which is getting built across in India.
Got it. Sanjay, with respect to corporate venture capital, that's definitely a subject that we'll touch upon, in this conversation. We'd love to get some more perspective, from you on that. But before we get into that, we'd love to get Paula's sense also in terms of, how she's seeing things emerging, and what are some of the trends that she's seeing are going to become instrumental for our future.
Sure. I think a great point was brought out by Sanjay. One is on the underlying technology, which is enabling new sectors to emerge. The other is external environment. And the third is the ecosystem expansion, which is including corporates and family offices, which, I mean, till about 3 years ago were very silent, mute observers, I would say. So I think, if you combine all of this, then there is a lot of new sectors which come up as well. I mean, let's take health, for example, right? I mean, health was a PE play, but with the underlying technology and with COVID and the changes that it brought upon us, we've got so many health tech, health focused.
Got it.
I think we lost.
And
Lost Paula.
I think we lost Paula, yes. Great. No, never mind, Sanjay. In fact, till Paula can join us again. There's another question for you, and given the fact that you did mention that we had so many sectors which we were looking at earlier, and now the way we are looking at things in the future. But we're also in a very dynamic situation. The kind of trends that worked earlier are not going to work in the future, or there's a lot of new sectors coming in. So given this instability of what is the business idea to pursue really, for some of the startup founders are there with us here today. What would you suggest what do you suggest about the support that is required for them to grow, scale, or understand what business to really get into? How should one evaluate that?
So, yeah. So Siddharth, idea here is a lot of the startup founders who would pitch to us and, check across with us, what do you think of this?
Sorry,
idea?
my computer just crashed for some reason.
Hey, welcome back.
Welcome back.
I'll just finish this one, Paula. So, idea here is, when they pitch across their whole startup, it's all about saying that what do you think about this idea? Always, we tell them saying that first, let's look at the problem, what you're solving, right? How big is, check the demand side, right? How large the problem is, what's the market opportunity? Is this a, painkiller idea? Is this a vitamin or candies? What are you building, right? If it's a painkiller, the idea here is everybody needs it. The frequency is very high. The immediate solution. It's like the system is broken and you're solving it. Vitamins need a lot of capital to create a consumer habit change, right? And the third one, candies, is these are all luxury market which it takes long time in terms of a decade over to create a habit or a brand creation kind of stuff. So idea is you need to pick your markets accordingly and how passionate you are, because startup journey is not for faint-hearted, right? It's a tough journey to be built across. So as an entrepreneur, before you embark upon, you should have that passion about that idea or that solution. So that's where I think I would, mentor my startup, saying that, you should have something which is mission driven. Money is a byproduct. It will happen across if you are building a startup which is solving somebody's problem, right? If you're building something what customer wants across, and automatically you will see across product market fit, and capital will flow across, in your startup. So that's how I would put it across, Siddharth.
Well, it sounds very interesting. Paula, in fact, we lost you when you mentioned healthcare. So love for you get your sense in terms of how you're seeing this journey evolve. And secondly, if you could also add to that in terms of from your perspective, what is the support that some of these startups given that we're in such a dynamic environment now?
Sure, and apologies, my computer power just went off. So, I was talking about new sectors, and one of the sectors which has really emerged is health and wellness. I think we are appreciating, our own well-being much more now, including mental and physical. So, a lot of those healthcare startups have seen a good amount of traction. We have funded a couple of companies. One is a diabetes reversal company, and again, because of technology, there are so many things one can do now to monitor your health, to act on symptoms as soon as you see them. So, it has got amazing traction, and, people are not only walking, etc., but they're talking to mentors, they're talking to peers. So this whole community aspect has come into, as a business model, has come into very many sectors, and health is definitely one of them. We've also funded a couple of other health tech startups which are developing new technologies, and like Sanjay said, some of these require the founder to have a lot of passion. Some of them are not easy. They take time, and you need investors and founders who are aligned and are working on it. Another sector that has really emerged and which wasn't very much around 3-4 years ago for early stage is that of sustainability and climate change. Again, I think over the last few years, we've recognized how important it is for us to be mindful of what we are doing to the environment. And so sustainability has cut across sectors, and that is being integrated into so many, different verticals. That again, lot of companies we are seeing in this, of course, EV is a big thing. Electric mobility is a big thing, and lot of action happening there. But we are seeing, I mean, just the need for people to understand sustainability is big. We funded a company called Terra, which is actually for climate education, and they've had amazing traction, and they've been growing, very well. So it's a combination of edtech and climate. But again, we are seeing completely new type of sectors also emerging. Of course, fintech, education, consumer brands. It's not just access to or aggregation of consumer products, but these are people are building brands on online now using social media, and that is also spun off creator economy. So we have social influencers now who are really your ambassadors, your marketing people, and again, a lot of creators need platforms as well. So creator economy is a third sort of a new sector alongside the ones like enterprise SaaS, fintech, and edtech that were mentioned, and digital transformation across SMEs, right? So that's a big one as well. In terms of what kind of support, right? So that's the question.
Yes,
One
yes.
So let's take some of these new emerging sectors, where we don't have clear business models. That's where, as an investor with some experience, where we've seen some sectors being created. You're creating a business model in a sector which really didn't exist earlier. That's where I think we as investors can bring in our experience. I think product market fit and business model are the most key at early stage to be established. And if at that stage we can make sure that the founding team is focused not only on the product but on product market fit and how to really scale the business model and the revenue model. I think that's where we really need to interact. And if the founder is responsive, then it's really an easy game, because if the founder is passionate, which usually they are, if they take practical suggestions, advice, and work at it, that's really important. Money is not usually, if you ask founders, they say what we need investors for is for money. Yes, of course, they need the right resources, they need the money, but I think value-added investors are important. So if one can guide the at early stage, particularly the founders, to look at the problems objectively, that really definitely helps. So that's, I think,
I think
the biggest thing is to lend your ear to the founder.
uh, Siddharth, you are on mute.
Yes, unfortunately, I was muted by MC, so I'm unmuted now.
Sorry.
Great, thank you. So great, and Paula, Sanjay, I do realize that both of you have very different strategies, and both of you all have a very different approach of investing. And would love to get your sense, starting with you, Sanjay, in terms of when you're looking at making your investments, what are the 3 or 4 characteristics or the things that you look at in your investments before signing a check?
So typically, you got a standard checklist, but more or less, if you look into it, all startup investors invest on hope. There is very little performance metrics what we or data which we have to analyze, kind of stuff. So there's not much of history which we can dig upon. What we are investing is about future, right? And that's where we are like that window to the future. But still, what we will look is founders' right to win, in terms of how do we see those founders, their domain expertise, and why would they win in the market. Second is the market opportunity itself, how rapidly it is growing, how big the market is. The third one is business model strength, right? In terms of how would they make money, right? At some point in time, everybody has to make money. So how would they make money? The fourth one would be in terms of what is their unfair advantage, right? Typically, we would like to invest into startups which would dominate in their particular niche or area, right? Somewhere where they can create a monopoly. So those are the startups so what's the unfair advantage with that startup? And lastly, internally, we do ourselves a math saying that would we be able to have a 20x kind of return? So motamoti, these are all the parameters. But if I have to give you a rough rule of thumb, whenever we see a deck, let's say 15, 20, 30 minutes of pitch, typically first and foremost, इसमें पैसा बनेगा या नहीं बनेगा? That's a tick in a mind which happens across, right? Is there money to be made? Are these people who can make me money? How much money I can make? So investors are very greedy as a lot. So all they think about is money.
And your thoughts, Paula?
So, I mean, Sanjay has let the cat out of the bag. Investors do go after money, but I think what really excites investors, and I know Sanjay well enough that for him also money is also there. I think what really excites people like us, which is why we are doing the hard work of being early stage, is the pleasure of really the satisfaction of building out something which goes on to disrupt and which goes on to become a thought leader. And I think that is the biggest reward. Sometimes even best of our companies have not given us, my favorite companies have not necessarily given me the best monetary reward. Hopefully they give, both of them go hand in hand. Some of them do, but sometimes it's the timing, right? Maybe you time the product was ahead of its time, or something happened at that point. 2008 happened, and so on. So timing is an issue as well. When you get into the market, I mean, a lot of companies in sustainability which had better technology didn't survive because the ecosystem wasn't ready. I think external environment is also very important. A founder who can see that, if he's doing a Me Too, he or she's doing a Me Too company, which those models are there, then they must have some very, like Sanjay mentioned, unfair advantage or a differentiation, which is going to, be able to overtake the others. If it is a very disruptive model, then yes, there's a lot of money to be made if they succeed, but there's also, you don't know whether that, because there is no precedence. So you can take high reward, high risk, high rewards kind of a situation. And the third thing that I as an investor really bet on is on sectors. And you can go wrong. You can go completely wrong. We bet on, we didn't take a bet on e-commerce back in 2006. We said no to Flipkart, Lenskart, a lot of them, because we said, who's going to buy these things online? Based on our experience with some other companies like Redbus, we said it's a pain to sell anything online. There's too much friction because credit card usage is low, cash on delivery is such a pain, and so on. We didn't take the bet on e-commerce. We took the bet on e-commerce when it was a bit too late, when there were already many models, and we were betting on Me Too companies. So I think, you can take a bet on a sector if you really understand what that sector means. Personally, for me, I'm willing to take long bets on sectors which I'm passionate about and which I think are going to really create impact, like sustainability or climate. And there'll be some of these would be long-term bets. There are, people have taken bets on education back in early 2007, 2010 era, and they didn't work out at all. They didn't, because the underlying technology was not there. The business models were not right. Selling to academic institutions was a problem. But lo and behold, now it's education which is ruling the roost as far as unicorns are concerned, and they have truly created impact. So if you waited it out, you believed in education, you've seen where it has come today. But yes, there are a lot of roadkills on the way. So there is no typical formula, but if you believe in a sector that you want to build companies with leadership, you should study it, and you can take bets. So I, for example, am now taking bets on climate, on health, on creator economy, work from home, the sort of the newer paradigms. But you have to be cautious. You have to get founders who really are passionate and who understand what they are in for. Otherwise, what Sanjay said, they are the typical checklist you go through, the fundamentals. And in the end, there is hope that you will make money, not only for yourself, but also for the founder and all the stakeholders.
Got it. That sounds very interesting. And given the fact that there isn't a formula, and there may be some sort of preset checklist, and the sense that I get it's a lot of it is gut and intuition driven as well. I think it'll be great to get a sense from both of you. Whether talking about one company which you thought didn't meet all the checklist criteria, but you believed in and it did really well, or if you want to also talk about an example which you thought was met all the criteria, but basically you end up failing. So, love to get some case study examples from you all about some of the companies that you've invested in, which you're really excited about.
So, I mean, Siddharth, as I mentioned across, we invest on hope, and all these startups, when they begin across, they have to start with a very niche, small market, right? And then their ability to expand in adjacent markets. So when we do the first check, sometimes we feel, this market is so small that it's never going to grow across, and suddenly they become dominant in that market, and then they scale up. And you look at the stories of every big companies today, they started very small, right? Like if we go back in history, Facebook possibly was just a 10,000 people market, a college room network, right? It never would have thought across saying that, okay, it's going to expand so huge as a social network, right? That word of social network itself was not there. So it was just a 10,000 people getting connected over internet. That's how these opportunities are, right? Airbnb, who would think across saying that you will allow somebody to stay in your home, one room, give them bed? I mean, tough to take those bets. I was investor in Oyo, and when we invested, it was just a listing platform. Did I know Oyo will become Oyo? I would have invested all my money over there, right? So nobody knows, and founders pivot, right? What we look into is, when does this idea have that merit? And I would say across at least, I would say 70-80% of the founders pivot as the things grow across, new rounds of funding happen, the whole idea changes across. Does that founder have that ability to transform the company themselves to that exponential thinking, right, as capital comes in? So those are the things which we look into it. But yes, I mean, personally, at 100x.vc, we look at over 10,000 odd deals a year. So a lot of anti-portfolio which gets created, right? And you pass across saying that, this is not looking great, and you pass on. And we are proven wrong multiple times. It's not there. Fortunately, I've got 4 unicorns in my portfolio, so I've been lucky in that sense. This is one asset class which I believe across, where you can influence an outcome, right? You work with the founders closely. You buy listed equities. You can't influence outcomes. You can't control anything. You buy real estate. You can just be on the sidelines and watch the prices go up or down, right? You can't do anything. Whereas in startups, you can actually work with the founder. You can actually influence an outcome. So idea here is, when we are looking at any portfolio or any ideas, uh, our ability to add value should be there, and that's where we end up investing. So for example, I've been very early into the crypto investing side. So I invested in a company called CoinDCX, and that's the exchange which is doing so well, unicorn in the space. But today, when I'm seeing across the same crypto renamed as Web3, and a lot of gold digging is happening over there, I'm sure people are going to lose money in many of the projects. What I'm seeing getting funded, which should not have been touched. Maybe I'm proven wrong. So these are very early bets which we take across. So I one part where I've learned across hard way is, I can be on sidelines and be a critic saying that ye to nahi chalne wala hai, right? And I'll be right more than often. Others is, I take my money, my own money, and invest into those startups and see what works out. Right? So that's how it is.
Got it. Got it. And Paula, an example from your side, or any thoughts?
No, sure. So, like I said, I really look for passionate founders in sectors that I believe in, and education is one of them. So when an academy team pitched to me, they had no deck. They just didn't even, they just said what they were doing. They said, we don't have a deck, we don't have a revenue model. But this is what our vision is, to really give access, the best access to students across India for cracking exams which are going to be changing their lives. It was very simple, and they were extremely passionate. The team was well balanced, and they said, "No, if you I mean, we are not going to talk about revenue model till we know exactly, where we are headed. We have built a good product, and the product was really good, and they had still a lot to do. I just invested in them, and I thought it to myself, and we made some memos saying, okay, this could be revenue model, that could be the revenue model. They could add this exam, and they could have this model. Eventually, I think they're making 1,000 crores of revenue, and I was worried whether they'll ever make revenue. So you have to believe in the founder's ability to execute on his vision, not on the plan that he submitted on that day. He really just, actually, this guy didn't even have a plan. He just said, I'm getting the best educators on. I'm building a great product for them. Students will come, they'll do well in their exams. And then we'll see, that'll be the next phase. So as an early stage investor, that has to click. Your value system, your beliefs have to be aligned. And then you have to hope that he will deliver. And you have to really help them at that stage when they need to pivot, or they need to add team members, or they need to do some changes. And they did, and they were then able to raise more and more capital because they kept delivering. So, of course, you have to really bet on the execution ability of the founder. On the other hand, I've had excellent founders who have given beautiful pitch decks with very great underlying technology, but founders so in love with the product and technology that they have no mind space for other stakeholders like customers and even investors. But at least for customers, you must think from what problem are you solving. Just because it's your technology, you can't have the technology push. So some very, very good, on paper, they seem like perfect, have completely become zero. In fact, I'm in the process of just sort of shutting down one such company where they just didn't think of whose problem they're going to solve with this brilliant technology. So you definitely, need to bet on the founder's ability to be open and to have a holistic view, or you have to just sell the technology and or license it out, which doesn't happen so easily in India. The company got acqui-hired, and we made 10 cents to a dollar. So you have extreme cases, and then on the other hand, like I was saying, we have bet on companies. We didn't bet on companies which to us didn't look good. The pitch deck didn't look good enough, or we didn't believe in the technology or the market opportunity more than anything. And a lot of them have gone on to do well. I think every week we will have an empty portfolio company, because today's day the velocity is very high. They raise money. In a month's time, you'll hear that they've raised $10 million. So there are a lot of ideas, and you don't really know a company has really succeeded. It's not just on the valuation. A company can become a unicorn, as you read in the papers nowadays, and or be a sunicorn or whatever, and then actually wither away because they can't. The fundamental model is weak. So I think I've learned not to feel FOMO, because sometimes yes, it's good that the founder's done well. You missed out. But you also don't know whether how long that's going to sustain. We tend to mix valuation with value, and that's again not the right signal in the ecosystem, because eventually value is created when they become an accepted leader, not just for the investors but for the whole ecosystem, including the customers and the entire industry that they are targeting. So yeah, I think in the end, you have to really believe in the entrepreneur. The entrepreneur must be able to execute, and you'll have some wins and you'll have some losses.
Yeah, in fact, that gives a very interesting question, and this is also something which has come from the audiences. I'll take some of these questions also parallelly. But over the last decade, we've seen some very strong valuations. So are these valuations justified? Are they here to stay? Because when we're looking at exits, and let's say Paytm listed recently, we've seen Nykaa listed, and the valuation of Paytm has fallen incredibly. Nykaa also had a bumper listing, and again you're seeing the pricing fall, apart from, let's say, the Ukraine crisis. Sanjay Oyo, I think, has had some plans for listing. So do you think these valuations are justified, or do you think there's going to be some sort of check going to come back forward?
So I'm not an expert on listed market, so will not be able to help on how listed market works. But I can only say that, at least from a startup market, it is not volatile, right? Our valuation stay for some time. It's so somebody talking about saying that startup is, this is the fair valuation. There is nothing called fair valuation. Everything is unfair in startup, right? We feed the winners, we starve the losers. That's how the mantra is. If I have to give my time, I'll give my time to my winners, not losers. There's nothing called salvaging in here, right? We don't salvage capital, right? We invest. While we invest, we are betting, saying that will this become a moonshot, right? Is this going to be an outlier? Every time we are looking for an home run, right? All my decisions of investing is, will this give me a home run, right? And that's where the whole investing is about. It's all about power law, right? Getting that one big hit in your portfolio. That's where the venture capital industry is. So you will see a lot of capital chasing, the same deals. It continue. I know that deal is doing well. I can pour in another 100 million, 500 million. I'll keep on doing that, right? And we have seen those success getting created across by Tiger Global, be it across with SoftBank, Inside Partners, and there are so many now momentum investors which are there pouring tons of money into the same set of startups. So you will, talking about that fair valuation, it's not what's going to happen in the startup side, right? And let's from a listed market, right? People call across, okay, these are getting corrections are happening, kind of stuff, and market is correcting with all this. I mean, I've seen across, for example, Jet Airways, right? The company was traded when there is no airline left, there is no employee in the company, and still people are trading that stock. Now, where does fundamental come across? You got the biggest of the corporate names in India, where corporate governance are taken for a toss. At least we know when we have invested in a startup what's happening over there. Equity investors are just looking at the paper which is getting published. They have no clue what's happening inside. So I think let's not compare how listed or startup valuations are there. Startup is a very different asset class, and you have to take it across in a different way. Yes, IPO as an exit is a great opportunity for startup investors, and we are thankful to SEBI for opening up that floodgates.
Got it. And Paula, I'll ask you an extension of that question. Because I do realize in our conversations you had mentioned earlier, before this, Zoom call really, was that there's an interest also to invest in a lot of traditional sectors from your side, like let's say agriculture or warehousing, logistics, and which are also getting very high valuations now, but also because they are scaling. But so what has really changed in some of these traditional businesses which are catching a lot of interest from investors like you?
Yeah, sure. I just want to touch upon the previous question, because it's a very important point, because all we hear about the startups is the valuation part. And I think, yes, valuation is important because that determines how much an investor will own in the company. I think it has to be taken in that context, because obviously there are a lot of roadkills in the model that we have in the early stage investing or in the startup investing, even as they go along. So a lot of capital will chase the winners, and that is the nature of the beast. And there's nothing wrong in it, because that is how categories are created, leaders are created. But valuation is probably given a little bit irrational kind of attention. We don't talk this in the same manner about the listed entities, so they are very different. I think a fundamentally valuable company will give you returns. How much returns? I think one should decouple it from the all the glory around valuation, but look at the very fundamentals of what this actually company has done in terms of disruption, in terms of value creation, by actually creating a whole new, look at all the e-commerce companies, what they've done to our lifestyles. I mean, these will be valued. And at some point, okay, they will have some setbacks, but I think they will give liquidity also, right, to investors like us who took the early risk. So having said that, I think, in terms of traditional sectors, I think what has happened today because of the underlying technology and which has given access to a large number of not only consumers, but also small businesses, traditional businesses have an opportunity to have non-linear scaling, which earlier was not possible. So digital transformation across, sectors like logistics, and we have seen, I think there are at least 2 unicorns that I can think of in the logistics space, which is earlier fleets of trucks, right? I mean, where is the technology? But actually, technology platform has given GPS, having all of those technologies has given huge opportunities. Look at agriculture. I mean, we have been one of the most inefficient agri industries in the world. Can we really change there? Even just the distribution. Again, with the underlying technology, if one can put it there, there is so much scope of putting in efficiencies, which can create multiple, returns in terms of improving their balance sheets, scaling, which was so smaller businesses can come together and we can create large businesses. So the opportunities are immense. So, I mean, 2 sectors that I mentioned are this. And again, if you put in sustainability in it, mobility, because again, there is a huge potential there for bringing about efficiencies, using technology, using newer technologies, energy saving, etc. So I think traditional businesses have seen huge value creation because of the startup approach, which is essentially taking some disruption. Even retail, if you see, e-commerce gave access to retailers to sell their products, but now there is brand creation. Look at Mamaearth, for example, and all these other brands which have been. Traditionally, this was not possible, to just create in such a short span of time a brand and to reach it to so many consumers. And that has been, if you take Nykaa, for example, that has been the success of it. That somebody in tier 4 city is now able to buy and also understand what is good, So it is a lot of things are possible now in traditional businesses, which will fuel the growth, which they'll have to change how they do some of it. But it is opportunities for investors as well.
Got it. Sounds very interesting. And given the success that both of you have had, I do realize that both of you play also the role of a lead investor in a lot of investments. And it's after that there are a lot of other investors either want to join you or they want to invest in the same startups. So from a startup point of view, how does a startup find a good lead investor or find the investor who they should approach first? And what is the role of a lead investor really? How should a lead investor?
You want me or Paula?
Yes, Sanjay, if you want to take it first.
Okay. So I think, lead investor is very important. In India, there is a lot of passive capital available, but very few active lead investors who would, put their neck on the line and say that this is a great deal and invest kind of stuff. So, once there is a lead investor, a startup can build the round. Passive money will follow on saying that, okay, if Paula is putting in money, let me write a check along with her, right? So very few lead investors which are there in India. I would say maybe hundreds, 100 or lesser kind of stuff, who would have done across deals which will be 50 and above kind of stuff. So need to find those, talk to the portfolio companies, see, get introductions, to those lead investors. And the idea here is the lead investor is not just negotiating and creating a valuation or giving you a term sheet. It is also helping you market your deal, right? They are actually your marketer or your ambassador, trying to sell your deal, build capital, because end of the day, the lead investor knows that more capital would be required in that company, and they would try to build the round using their social network, right? And what they offer is a social proof to the startup founder saying that their deal or their idea is venture fundable, right? Whenever, let's say, Paula will give a term sheet to a startup, that startup can go around with a bragging right saying that they've taken money from Paula and their round will get filled up, right? And that's what the value of a lead investor is. It's very important if any startup has to successfully close a round to find a lead investor, and the rest I think will fall in place.
Yeah, true. I mean, for the founder, it's important to get money into the company. But I think it's more than that. I think it's to get the right money in is very important. So the lead investor brings a sort of a credibility with them, and also support for the founder. So you can amplify the messaging of the founder to other investors, and also help navigate to the second round, because as early stage investors, our success will only come when we are able to raise the next round, Series A, seed round, whatever you call it. And again, there the lead investor will play a role, to guide the founder as to when is the right time, who to approach, and so on. So one is closing the round, very important, because the sooner in early stage is all about velocity. So the sooner you close the round, the sooner you can go and execute. And in today's dynamic ecosystem, all the more you really need to close it fast and move on. And the lead investor also, in terms of setting all the rights, and so you don't spend. You see, the early stage round is like your 7th, 8th grade final exam, right? It's you just need to go on to reach eventually the next stage. So you should not really be wasting too much time dotting the i's and so on. You should be quick, and 100x has come up with some a very good formula for called the safe note, which has been popular in the US, which really helps the founder close quickly and move on. So you get on to the real race then. So lead investor and the founders, if they're aligned, they can really build out for the next round.
Got it. And Sanjay, you had mentioned this one point, the beginning of this discussion, and Paula would love for you to weigh in all this also, because we are seeing, let's say, corporate venture investing happening. Vis-a-vis, I would say that the venture capital market is already at a slightly growth stage, and corporate venture investing is something that has, happened a bit later, but it's happening as well. So what is the difference between both of these, and what are the kind of startups that should approach either a corporate venture fund or should approach a venture capitalist?
So I mean, let me first take the side of the founders. For founders, if they are able to get money from a financial investor, they should take money from them first and then go to corporate. Most of the reason why I'm telling is most of the corporate venture capital guys have formed this division or a space for their strategic interest, not to create wealth. They are not financial investors. The financial investors will push the founders to scale, grow, help them with capital, new round of fundraise. Corporate venture capital more or less are going to saying that how would this idea add to my existing business? How can I use innovation on hire? Can I get innovation access very cheaply, right? And they very different way of looking at things. So let me give you an example. When I see a deal, and let's say the company needs across 3 crores, and the founder is miscalculated, saying that मेरे को 1 crore में हो जाएगा, right? I'm okay with it. I would actually rework the plan and say that no, you need 3 crores, because if I give him 1 crore, then that money is also down the drain, right? So if they don't raise the right capital, it will not work. Whereas a corporate venture capital guys, the people who are there would try to say, okay, ek mein ho raha hai, we'll give you 1, right? And try to work across. See, we would like to be a significant minority shareholder. We are never out there to say that, oh, we would like to run the business. But yes, corporate venture capital brings in a lot of resources which are not available with a financial investor, be it HR, be it customer access, be it the distribution of the product which is going to be aligned. So a lot of value which you can extract across with the corporate venture capital guys. And now, so at 100x, we work with a lot of CVCs, who would like to get deal access to various sectors which are aligned to them, and we work very closely with them. And we have seen the maturity now with a lot of the corporates understanding, saying that they are okay with now having a minority stake without control, which was never seen earlier. So I think there is some change which we are seeing across in the corporate venture capital side.
Got it. Paula, your thoughts?
Yeah, I'd just like to add to that. I think corporate venture capitalists are essentially, like he said, they're used to running P&Ls. They come from that background, and venture investing is anything but that. So, the example he gave is perfect. That if you need 3 crores, you need 3 crores, and otherwise you'll compromise on the next stage. So I think if corporate VCs need to understand that this is not a P&L of one of the divisions that they're looking at. I'll give an example of an IoT company that I have, and a strategic corporate investor put in money as a strategic, and all that they wanted was that they don't give this technology to their competitors, how quickly they can roll it out in their plants. That wasn't unlocking value for this particular company. So while they got some quick access, customer access at low cost because they could implement in their plants, it stopped the natural growth of this company that it deserved. Having said that, yes, if corporate VCs work independently and eventually unlock the value for a strategic purpose, that would be ideal. And they can, if corporates start looking at startups, we can get some exits as well. But by and large, I think they have to change the mindset and tune into the wealth creation that happens, or value creation that happens in the startup. And the startup has its own entity, its own identity, not a division of the corporate. So I think that has to be distinctly understood by the team that is managing the venture arm of, and some of that is happening now as people percolate from VC community also into corporates.
Got it. No, absolutely. Since we had mentioned that investors are greedy.
Just to add here, Siddharth, I mean, on the corporate venture capital side, today when they are investing into any startup, they should be thinking from the treasury side, right? The allocation has to come from not saying that, okay, let's try to, what is only aligned to the strategic benefit to the business. Today, a lot of the Indian corporates have got cash on their balance sheet. Now, they would be investing into various asset classes. Startup also is one of the asset class where treasuries should start investing into startups. If you look into a lot of the institutional funding globally comes from a lot of the university pension funds and endowments and stuff, right? And those guys are also allocating now in double digit to startup as an investment asset class. So treasuries in corporate should look at startup as an asset class. Yeah, go ahead.
Got it. I know I'm overstaying your time slightly, but I'm just going to be a little more greedy on your time. Since you mentioned the investors are greedy, but just want to get one sense from you also is that while you're a seasoned investors, there are a lot of individual investors like us who are interested in startups, but we find it tough to either find startups or evaluate them. So would you suggest that for a lot of investors they should take the direct investing route, or they should work with a startup fund and be part of that? So how do they make that decision really? What is the right approach for an investor?
I think it depends on the individual and your risk appetite and how hands-on you want to get. You can, there are various investing platforms that you can, AngelList is there, Let's Venture, the angel networks are there, so you can use those to get deal flow. Or you can, if you know people, you can invest alongside them. I mean, these are a high risk asset class, so one must keep that. And it's not very liquid, not easily liquidable at all. So they're very non-liquid and high risk investment. It may not always be easy to get into startup funds, but if you trust the fund manager, you think they have a good track record, and you can invest some there, and then you just sit back and see what happens. That's also a good opportunity to leave it to the veterans who or the fund managers who know how to do it, and then you just get a flavor of it. And then once you sort of see, you can maybe get a lot of funds give you direct investing opportunities once they have already built out the company a little bit, or they've done the hard work of curating the deals and investing all directly, and you can then alongside invest. So I think now in today's ecosystem there are multiple opportunities, multiple possibilities.
So I started my journey as an LP to private equity fund. It was too passive kind of stuff, and I mean, again, it depends upon whether you like to engage across with startup founders, get your hands dirty into deals kind of stuff. And if you like it, you should invest directly rather than a blind pool kind of fund. You have various platforms, as Paula mentioned, across online, offline angel networks. But whenever you are doing across, you should look at a couple of things. One, what. So let's say angel network, right? They have an incentive to market a deal, right? Because they earn commission. Their whole business model is there to earn on it. Now you got investment bankers who will sell you the deal, right? They'll bring you, this is a great deal, why don't you look at it? A proprietary deal, I'm showing you first, kind of. And again, it's their job to sell a deal. They earn out of it, right? So you should know which deals to pick up, right? If you don't know, then it's better to go to a fund manager and invest, give them pay a fee. It's an expertise which you are buying across, and check their past record and see if you like the fund manager, put in money over there kind of stuff, or else look into syndicate. That's why I said, let's say Paula is doing a check, and if you join her syndicate, it's her skin is in the game, right? What more do you need? It's like you can just find those lead investors and join those syndicates, right? It works very well.
Got it. So thank you so much, Paula. Thank you so much, Sanjay. I think this has been a very insightful discussion, and would love to get from you all, some closing remarks in terms of any point of view for startup founders out there, or anything that you would have touched upon that you'd like to add.
If there are startup founders who are looking for a first check, do write to us at pitch@100x.vc. What more can I add across on this, Siddharth? They can write to us. We do the first check, and again, while we are a VC fund, SEBI registered, but again, this is a family capital which we are investing in through a fund.
I think Sanjay had the last word. Definitely founders, I think angels look for good founders. Angels love to interact with founders and hear their ideas. So do feel free to reach out. But one only footnote I will make is, if you want to do a startup, do it because you believe in it, not just because it's the trend today. And understand it's a lonely and long journey. It can be a lot of fun, but a lot of hard work as well. And investors can be your friends. And so look for investors who are aligned with you and can be with you on the journey. It is a tough journey, but it can be very rewarding as well. So all the best to all the founders out there, and yeah, do reach out to Sanjay or me.
Great, thank you so much, Paula and Sanjay. This was really a great session. Great learning for all of us. Selvi, if you could take it forward, please.
Thank you. Thank you for that wonderful session. It was really informative. And I think all who have joined have really valued from the discussion that took place. So now, as we conclude, may I request Mrs. Sunita Ramnathkar, Chairperson, IMC Startups and Innovations Committee, to propose the vote of thanks. Over to you, Mrs. Ramnathkar.
Thank you. It is my proud privilege to propose at the end of this essential, non-discriminating and highly interactive session. In line with the overall focus of the hour, supporting Indian startups and helping them to scale through knowledge and networks, the Startups and Innovations Committee of the IMC series of workshops, which is aimed at helping startups innovate, and entrepreneurs would definitely be a great measure towards scaling the growth of the startup ecosystem. We wholeheartedly thank our esteemed speakers, Paula Mariwala and Mr. Sanjay Mehta, for sparing the valuable time to enable IMC to spread awareness to the startup ecosystem and to help them move in the right direction. We also thank Mr. Siddharth Lulla for ably moderating the session with right intuitive questions and make it such an interesting session. Most importantly, I must thank all the participants for being so interactive, asking incisive questions and drawing the best out of this talk. Your presence is a source of encouragement to IMC. Good evening, and please do share your feedback with us, which will enable us to improve our deliverables. And in due course, based on your suggestions, it will take just a minute or two, but will go a long way for us to improve our sessions. The feedback link is provided in the chat session by the IMC team. Thank you. Any questions? Selvi, do you want to take some questions? Or?
No, thank you. Thank you very much. The questions were answered as they were coming in the chat. So like all of them were answering. So that also has been handled. Thank you very much. Thank you to all the participants.
So much.
Thank you, Paula. Thank you, Sanjay. Thank you so
Thank you,
much.
Selvi. Thank you, Siddharth. And thank you, Sunita.
Thank
you, everyone. Thank you.
Thank you. Please fill the feedback form, participants, so that we can keep improving our events. Thank you.
Thank you.
Thank you. Thank you very much. Reach out to info@aureolus.co.in or info@stanfordangels.co.in. Or investors can register at https://summit.100x.vc. Thank you. Or email on pitch@100x.vc. Thank you. Thank you, participants.